We just saw the break go, the big bounce. And now we are at the institutional trend. So this is the last section of our market trend before we get to the Fibonacci. So this section is a special section, okay? It's different from the rest of what we've seen up to now. And this section will be applicable, I would say, 20 to 30% of the time in the market, okay? So this is not our main way of trading, okay? So this is not our main trading, but this is something that we can use sometime when we see certain opportunities that are in the market, okay? So don't get confused. Don't think that you will be trading this way from now on, okay? This is just an extra that I decided to add on, okay? We will use it from time to time, but I would say most of the time, 80% of the time, we are going to trade just like we've seen before. So institutional trend, okay? There's a reason why the market almost always respects the trend line, the support, the resistance, the MAs, the psychological level. It's not by chance. There's a reason behind it. And the reason why is that institutions have people, robots, nowadays it's 90% robots, called market makers, okay? The job of a market maker is to structure the market in a logical and structured way, not allowing it to become random and chaotic. They are the architects and engineers of the market. If maybe you remember when you first opened a chart, maybe on TradingView, maybe on MetaTrader, you know, when you first started trading and you looked at the chart, it looked very random. It looked very chaotic. It did not look structured at all. But the more time you spend in front of the charts and you see that you can trade in a consistent way and you can make trades over and over and over again, and you see there's something that is you know, structural. You see that nothing is really left to chance. You know, the trades are not random. The market is not chaotic. There must be a meaning behind that, right? The meaning behind that is the market makers, okay? They are the ones who are, like I said, the architects and the engineers of the market. There's too much money involved for the institutions to just, you know, let everything up to chance and, you know, not try to structure their business, you know, as best as they can, okay? The market might look random at first glance, but it's always structured and organized. Nothing is left to chance, really. There is too much money involved. So knowing this, from time to time, when institutions have a specific planned projection, okay, when do they have a specific planned projection? When the fundamental, okay, is very strong and very predictable. So right now in the world of today, with the pandemic going on and everything, is the fundamental very predictable? Absolutely not. Is the fundamental very strong? Yes, but you need to have 1 and 2 for the institutions to have a specific plan projection. Now it is difficult to create a specific plan and a projection because in 3 months the situation can be you know, very different from today. In 6 months it could be, you know, the complete opposite. We don't know. So the very predictable part is not applicable today. But if you go back a few years, let's say in 2017, 2018, even 2016, 2015, the market was way more normal, way more predictable. You were able to make, you know, some long-term trades. The fundamental was clear, and the institutions would build specific plan and projections for a few months, for a long period of time. Okay, and now when we get over this pandemic and everything goes back to normal, maybe in 1, 2, 3 years, this is going to start to be a bit more relevant. Let's say it like that. So when institutions have a specific plan projection that they want to realize, they will contact their market maker team. Okay, so basically those guys nowadays are the quant guys. Okay, so they're engineers, programmers. They have a big team like that in institutions, and have them design and create what I call an institutional trend. They might have some other terminology, doesn't matter, but they will call the quant guy, the market makers, and they will have them design really the market from A to Z. Now, these institutional trends happen around 20% of the time on the market. Okay, so not very often, and 20% when we have a very strong fundamental situation and very predictable. Okay, so like I said, it's not very often, so I'm not going to spend too much time on this section, but it's good to know. But when we identify them, even if they are rare, we can profit from them, and they are clean, easy trades. So there are 5 rules to determine whether we are looking at an institutional trend or if it's not an institutional trend. Okay. So rule number 1, the trend has to be represented in 4-hour or daily. If it's 1 hour or below, it's too small. It's not an institutional trend. The angle of the trend must be around 45 degrees. It must be sustainable. So the trend must be sustainable. It cannot be the trend cannot be too aggressive. It cannot go too fast, too high. So it has to be around 45 degrees, sustainable. The trend must have a clear uptrend, downtrend. That's pretty basic. You must prove that the heart line exists. So what is the heart line? We are going to see that. And you must be able to count the Elliott waves. So let's start with rule number 1. So I took an example here. We have a beautiful uptrend. Okay, this is a case that the chart is already laid out. In reality, you would not have all this information. Maybe the screen would be cut off here. Okay, but for the first example, we will look at the entire institutional trend from the beginning, and we will go through the 5 rules to explain them and see how they apply. So rule number 1, the trend has to be in 4-hour or daily. Here we are in 4-hour, so that is perfect. Rule number 2, the angle of the trend must be around 45 degrees. Does it look like 45 degrees? Yes, it's sustainable. It's not too narrow. It's not too fast. It's sustainable. 45 degrees. That's good. The trend must be a clear uptrend or downtrend. Here it's uptrend, so that's clear. Perfect. And then we get to number 4. You must prove that the heart line exists. What is the heart line? It's going to be your 50%, okay, of your channel, of your trend. Just like if you would cut your channel in half, you would have your heart line. So basically, it's the blue line right over here. So basically, when you are on TradingView, you do your analysis and you put your channel like this. You can go in the settings and add this heart line, this 50% line in the middle. And what does it mean that you must prove that it exists? Well, it means that you must look at the chart and see if this heart line is respected. Okay, does the price go through like it doesn't exist, or it respects it by creating support, resistance, reactions on that heart line? So here we see you have a support, resistance, 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 bit of consolidation here, support, support, resistance, resistance, support, support. So this heart line is proven, it is valid, since it is respected. The institutions, they use this heart line to trade, basically. Okay, in a normal channel, if it's not an institutional trend, usually the heart line will not exist. You can try it at home, you will see it by yourself. You can try to put that 50% on the channel, and you see the market will just, just go through it like it doesn't exist. But in the case it exists, it's valid. Now, I decided to add the 25% and the 75% as well. So we have the 50 in the middle, but we also have the 25 here and the 75% here. Here is the tool that we are going to use to trace the channel this way. And the settings are underneath. So on your trading view, you can adjust it. And basically, it divides our whole trend into 4 zones, right? From 0 to 25, 25 to 50, 50 to 75, and 75 to 100. And if you look at the 25 and the 75, you will see that they are respected as well. Nothing is there by chance. The market is not chaotic. Everything is structured. Everything makes sense. The institutions, the market makers, the robots, the quants guy, they all structured this trend from scratch. All right. So zone number 1 is where the movement begins. It will be at the bottom in an uptrend and at the top in a downtrend. And of course, zone 4 is when the movement ends and the correction begins. Now, the good thing is with some back testing, I found many of those institutional trend. And I found this observation, okay? When the market breaks the heart line in the direction of the current trend, so if it's an uptrend, it needs to break it to the upside, we have an 85% chance to reach the end of zone 4, okay? So if you would, just close your eyes, wait for that breakout of the heart line in the direction of the trend, you would have an 85% winning rate. Okay, without even looking at the fundamental, without looking at anything, you would have that 85% chance to reach the end of zone 4. Okay. Market makers and robots are behind this structured market. Nothing is left to chance. Now, just to prove this point, I decided to cut it even further. So instead of having 4 zones, now they are 8 levels, okay? And if you analyze the 8 levels, you will see that they are respected. The support, the resistance, the rejection happen on every little one of these, we'll call them mini heart lines, since the heart line is the middle one here. On these levels, we can even call them key level trend lines. Everything is respected. So if you find an institutional trend, you can divide it in 4, you can divide it in 8, you can divide it in 16, 32, 64, 128. You can go in 1 minute, divide it in 256, and you will see everything is perfectly calculated and perfectly structured in the market. And this tells you that nothing is left to chance, and it's a mathematical program with money that creates this sort of behavior in the market. So it's very fascinating to see, and it's very important to understand that the market is not random, and that there's a logic behind everything. Now, of course, we're only going to use those 4 zones. You don't need to divide in 8 or 16. That's too many lines. So we're going to keep it simple with 4 zones. And you're going to add everything that we've seen before. So you have your key levels, you're going to have your trend line, you're going to have your MAs, you're going to have everything as per usual. But the extra bonus is that you have the institutional trend with the heart line. Okay, and you know that the market is not random, it's very structured. The institutions have a certain plan, and if you understand that plan, you can follow their movements. So Rule number four was good, so that was to prove the heart line. Now, rule number five, you must be able to count the Elliott wave. And when you display them on your chart, it looks like this. So 1, 2, 3, 4, 5 waves are in the Elliott waves. Okay. So what are Elliott waves? Okay. Maybe you are familiar with them or not really. Okay. They're composed of 5 waves. Okay. So 5 waves. 1, 3, and 5 are impulsion waves, which means it's in the direction of the trend. So in this case, so basically direction of the trend, they are the one who push the price, direction of the trend. They pushed the price in the direction of the trend. And then the correction waves are, as the name says it, a correction of the price. Usually we will stop at 5 movements. So there's gonna be 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. Okay, always divided by 5 section. Okay, wave 1 right here, wave 2 here, wave 3, wave 4, and wave 5. 1, 3, 5 impulsion, and 2 and 4 correction. Pretty simple. However, sometimes, okay, it can get an extended run, extended more than 5 waves. If the institutions want, to push their prediction, their plan a bit further, it can extend to 7 or 9 waves. So it can do 1, 2, 3, 4, 5, 6, 7, 8, 9. Okay, so you don't always get those 5 waves, but us personally, we're gonna stop counting at 5 because 7 and 8 waves are very, very rare. Now, when you count your Elliott wave, when you trace them, there is 3 rules to follow. Rule number 1, wave number 2 cannot be lower, higher than the beginning of wave number 1. So basically, if we do it like this, okay, this is wave number 1, this is 2, this is 3, this is 4, this is 5, okay. Wave number 2 cannot be lower, higher, depending on the trend, and then the beginning of wave number 1. So the beginning is here of wave number 1, the end of wave number 2 cannot, come lower than here, okay. So this will not be good. In this case, it's above, so it's good. Number 2, wave number 3 cannot be the smallest of the impulsion wave. So if you take number 3 and you compare it to number 1, okay, and eventually to number 5, it cannot be smaller. It cannot be the smallest one, okay. Usually 3 is going to be the largest one, the bigger one, and it's almost always going to be bigger than number 1. And then lastly, number 3, very simple once again, wave number 4 cannot come lower or higher than the end of wave 1. So end of wave 1 is right over here, right? So that's the end of wave 1. Number 4 cannot come lower than here. If it comes lower, it's not good. If it's at the same level or above, like in this example, then all good. The number 4, the correction is respected. And those rules are the rules that the institutions use. So when the quant guys, when the market makers structure, the market, they will do it in 5 waves, and they will follow these 3 rules and probably 90 other rules that we don't know about because, it's not relevant for us. It's relevant for them, so they can build that trend. Okay. Us, we just need to know these 3 rules, but there's probably another, 90 rules that are very complex and very advanced, okay? But we don't need to know them. So basically, the Elliott waves are a way to synchronize the charts of a financial institution. It's a global standard, okay? So when an institutional trend starts to be built, every financial institution know that we have at least 5 waves, Okay, even if they don't, go for lunch together, if they don't, if HSBC don't call, JP Morgan or Goldman Sachs, they know that there's going to be 5 waves in that movement. And even the rules are going to be the same. So even if the banks don't talk to each other, since it's a global standard in the industry, everyone is going to participate into that institutional trend. So here, if we look in our example and we go through the 3 rules, we said rule number 1 is that wave number 2 cannot come lower than wave number 1. So that's good. Wave number 3 cannot be the smallest one of the 3 wave. Okay, so smallest one, okay, in terms of pips. So if you measure from here to here, this distance, it's bigger than 1 and it's bigger than 5. Actually, it doesn't matter if it's bigger than 5, since it's bigger than 1. The rule is that it's not the smallest one. And then the last rule is number 4. So wave number 4 cannot come lower than the end of number 1. So in this case here, they are pretty much at the same level. Okay, so this is good. So wave number 4 is not lowered. It did not go below the end of wave number 1. So that rule is respected. So now our 5 rules are respected. So that means we are indeed in an institutional trend. And if we push a bit more, our analysis of the Elliott waves, we can add the ABC correction wave. Okay, and what's the difference between the 1, 2, 3, 4, 5 and the ABC correction wave? Is that the ABC correction wave is only going to happen inside the correction waves, and the correction waves are 2 and 4. Okay, so inside 2, which is here, and 4, this whole correction, the correction is going to take shape into a certain form. It's not going to be a random correction like this. It's not just going to be a straight line. It's going to be in the ABC form. Okay, so you have the first impulsion, you have the correction, and another impulsion. Impulsion, correction, impulsion. So A, B, C. A, B, C. You will always have it at that form. Okay, so that's very important to know. Now, what happens if the institutional trend doesn't follow the 5 rules perfectly? Okay, if there's one of these rules that doesn't work, you have 3 out of 5 or 4 out of 5, automatically it's not an institutional trend if not the 5 rules are respected. However, it becomes a structured channel, which means it's in between just a regular channel that you would see anywhere and an institutional trend. It's like an in-between. Okay, it's not quite a big, proper institutional structured trend, but it's not a regular channel that you can see at any time. It's in between. So what's the difference is that the 4 zones will not necessarily be respected. The 85% hardline rule will not be applied, and there won't be any Elliott waves. However, the market is still very structured and more previsible. You can make a better trade. It's more predictable than a regular channel. Now, knowing all this information, we come to the conclusion. What can you trade in an institutional trend? What's the goal of knowing all that information? Okay, you can trade wave 3 because it's the principal wave, it's the biggest one, and you cannot trade wave 1 and wave 2 because you don't know that it's an institutional trend yet. So if the chart was cut here and you only see what's here on the left, and you don't see the future, you don't really know that it's an institutional trend. But as soon as you have this point and the third wave is starting to get formed, if you're a good trader, you can expect it and you can start trading the third wave. So wave number 3, we can trade that. Then we can trade the BC correction wave of wave number 4. So 1, 2, 3, 4, 5. Here in the 4, okay, if we zoom in, that 4 is going to be A, B, C, and then it's going to continue the movement, right? So A, B, C. You can trade the B to C movement, okay, which is usually a lot of pips in that correction. And then finally, wave number 5, which is right over here. Very simple. You have 1, 2, 3, 4. And if you get to 4, there's going to be the 5th one. So this one is the easiest trade. Okay. You might just trade wave 3, skip this one, and then trade wave 5. You might skip wave 3 because you've been too late and you did not see that it was an institutional trend before, so you just trade wave 4 and wave 5. Or you might be very, very careful, you're not too sure, and you just trade wave 5 at the end. In any case, those are easy trades, and it only needs you to spot the institutional trend, because when you are in them, it's a very high probability setup. So if we take that example and see how I traded it, okay, it would look something like this. Okay, so you have wave 1, wave 2, and here you have your big bounce at the start of wave number 3. So you have a confluence of this trend line, this counter trend line here. You have this key level, this straight key level here, and you have also this double bottom. Okay, so here you have 4 confluences for your big bounce. Okay, don't mind the stop loss and the take profit for now, because we're going to see it right after with Fibonacci. What's important here are the entry points. So you enter here in your institutional trend. And now I entered there because I'm used to it and I saw many of them. But if you did not see it, you would just do the other trades later on. All right. Each time you make a trade, okay, you always want to identify your obstacles along the way. Okay, so I entered here with the big bounce. I want to see what are the obstacles along the way. So I have this 25%. I have here this counter trend line. I have here this heart line with my key level. I have this 75%. And finally, here I have my 100% with the key level. So basically I have 1, 2, 3, 4, 5 obstacles. Okay, so in trade number 1, 5 obstacles along the way. Okay, on every trade you do from now on, if it's institutional trend or it's just a regular trade with a big bounce or a break or go, whatever trade you're going to make, you always need to identify the obstacles along the way, because sometimes you might have a take profit and maybe the trade is going to go halfway and then reverse on you, and then you're going to end up losing the trade, right? And that would be pretty, sad, since you made all that work, you were in profit, you had many pips, and you end up, losing the trade or being at break even. Okay, that's not optimal. So that's why you want to identify the obstacles where the market could bounce. And each time you see the market reaching an obstacle and having a reaction, so each time you have a reaction on an obstacle, okay, what do? Partial profits. So partial profits. And as soon as you take your partial profit, also stop loss, break even. You protect yourself. Okay. In the case here, I would say the real reaction was this area right over here. Okay. Here, I started to have some heavy rejection on the obstacle. Maybe the market would reverse. Maybe my institutional trend was wrong, right? You can make mistakes. So right over here, I would take a partial profit and put my stop loss to break even. Now, how much percent of your trade do you close? It's up to you. You can close 50%, you can close 75%, you can close 20%. That's up to you, depending on where you are in the trade, how much you believe in that trade, what are the confirmation, your trading journey. Did you just start a fresh account and you want to secure some profit first? Or maybe you have a bigger account, you've been trading for a while and you don't mind letting the trade run. So it depends on you. The important is that you take partial profits and you put the stop loss break even at that same moment. All right. Then here, just after here, you see we have we added a position. If we clear everything, you see here we entered a second position in the trade. So here we have a break hook go of this counter trend channel. So just same thing as we saw before, and you would enter there, break hook go right over there. It could even be considered a big bounce technically, because you have the 25%, which is this trend line here. You have the counter trend line, and you have the 4-hour key level. So you have a confluence of 3 elements. Okay, you even have a small double bottom here, so you could even say 4, and it's like a mix of big bounce and break hook go, depending on how you look at it. So in this case, you would add a second position right there, same number of lots. Same. So let's say you opened one lot here, depending on your trading account, you would open one lot here as well. Okay, you would always open the same size. So each add of position, okay, must be either when you see a break hook go or a big bounce. So basically, it's like you're doing a trade inside the trade, but it's the same direction. Okay, so every time you add a position, it's either break hook go or big bounce. Okay, and it's like if you did not make this trade, you would have done this trade by itself, but they happen to be in the same direction, in the same idea, in the same fundamental direction. So it's adding a position. And then lastly, you see this entry here, third position on that trade. And you might say, well, Sammy, I don't see any big bounce or break hook go. And that's the exception with the institutional trend. What did we say? When we break the heart line, we have 85% chance to reach zone 4. Okay. So basically, I just added a position here based on that statistic. I already have 2 good positions running in profit, so I can, I can tell myself that I can open a trade right over there. By itself, I would not have just entered a trade like that. But if we take into account the first and the second position, we take in the 85% rule. We broke the heart line here. Everything is good. I would add that third position and close the trade at that moment at the end of zone 4. All right. Let me just change the color so okay, we see better like this. Then you finish wave number 3. Okay, you know that wave number 4 is coming after 3, 4, and you know that 4 is going to be ABC. Okay, after 3, it's going to be ABC4, and you're going to resume the 5th wave afterward. And we said that we can trade the BC of wave number 4. So here I have my entry point, big bounce once again, double top, trend line, 75%, and key level. So 4 elements of confluence at that moment, big bounce, enter the trade at that moment. You aim for the end of zone 1, okay? And you will adjust, your take profit depending on how far the price moves. And I decided to add another position here because there was another big bounce. So I have my heart line, I have my trend line, and I have my 4-hour key level. Okay, so here it allows me to get a level of confluence, add a position, and basically close it at the end. As soon as I close this trade, I can open the next one, which is the trade on wave 5. Okay, so I have 1, 2, 3 bounce here on this trend line. I have the key level. I have this trend line once again. I have a nice level of confluence, so I can I can enter a position here. Okay. I could have added another position here if I wanted to. So I entered the trade there, but I could have added another position there. Why? Because we have an inverse head and shoulder right there. Okay, we have a chart pattern that we just saw. So since I already have a nice position here, I have this, head and shoulder, inverted head and shoulder that lands perfectly on that 4-hour key level. Inside wave 5, it's the easiest one, it's the most guaranteed one. I could have entered the position there, and of course you identify the obstacles along the way, and I decided to add a position here, basically 85% chance to reach zone 4 when we break the heart line, and we have some sort of break hook go of the heart line right over here. Okay, and that's how you make some trades on the institutional trend. Okay, so that's 3 trades. Okay, 1, 2, and 3. 7 positions. Okay, because you added positions throughout the trade, and in total you made 3,057 pips, and it took you 45 days from this trade to the last one here. So from here to here, since we are in 4 hours, this is about 45 days. So if you wanted to, you could have spotted that institutional trend and not look at any other currency for that month and a half. Just focused and try to find the perfect trades, perfect entries, traded perfectly as much as you can, and you would have made 3,054 pips. Okay, and what's your risk? Each trade. Well, here it's between 1 to 3%. Here it's between 1 to 3%, right? And of course, here it's between 3%. Because each time you add a position here and here, you don't take extra risk because you always put your stop loss to break even to the previous position. So stop loss break even, and this one is running, right? When I added this one, stop loss break even. Okay. So basically, you risked between 3 to 9% over the span of 45 days, and you made 3,054 pips. I don't know how many percent that is. You would have to do the conversion, but you get the idea. If you were doing some scalping or some small day trades, if you were going, 3 pips each trade, how many trades would you have to do to make that 3,000 pips? You would have to do 100 trades, right? Let's say you risk only 1% per trade when you do your small day trades. You risk 1%, you risk 100% of your account in those 100 trades. Okay, here I risk between 3 to 9%. Here you risk 100%, and you put way more time than me. Okay, and we get to the same result. And I put less time. My trading was more, efficient, more professional. I had way less risk, than you, and I made that same amount of pips. Okay, and actually that's not it, because those 100 trades, are you going to win 100 trades in a row if you doing some scalping or some day trading? Absolutely not. Okay, so you're gonna have a lot of errors here. Me, if I make only 3 trades, I can win 3 out of 3. It's not unreasonable. If I have everything correctly like that, it's very doable. It's very solid. Okay, so that's the difference between a retail noob, okay, and a pro FX trader. That's how you grow your account. That's how you manage your risk. That's how you really become good at trading. And yeah, that's the way to do it. Of course, this is more difficult to master. So difficult to master. So no one is doing it because it's too difficult and they don't know what they don't know. And the retail noob, that's very easy. So everyone is doing that, okay? But if you want to become a pro FX trader, you need to learn how to properly trade, be patient. It's difficult to master, but once it's mastered, you see that you have a tremendous edge on everyone else, okay? Hope it makes sense. So this is an example of a channel versus an institutional trend. So this is just a regular channel. You see, it's not really structured. There's no hard line. There's no Elliott wave. It's just, a channel with two trend lines. And this is a institutional trend. You see the difference right away. Okay, this is made with a software on a computer, and this is made organically. Because the banks did not have a specific plan, a specific agenda that they wanted to, create. So they just reacted on the fundamental and basically traded day to day, week per week. Okay, and you see the difference between something that is organic and something that is created in, you can almost say it's created in a lab. Okay. We have some questions. I'm just going to answer them. When it comes to taking partial profit, when we see reaction on an obstacle in the early stage of our trade, do you need to have multiple positions open from the start of the trade, or you can close partially lots? My understanding is that it's illegal in Canada to close partial lot. It's not illegal in Canada to close partial lots. So basically, if you open one lot, okay, you don't need to have multiple position. So basically, one lot, if let's say you want to close 50%, you can go either on your MetaTrader or your C trader, and you go to modify the order, and basically you can cut 50% and you will be left with a position of 0.5. You don't need to open multiple position and close them separately. You can close a portion of that position even if you have only one position. Is the institutional channel correlated to fundamentals? Yes, of course. Like I said, for the institutional channel to exist, it means that the institutions have a certain plan, a certain specific agenda that they want to, apply, create on the market, and that's based on fundamentals. Which pair was in the example? I think it was Euro AUD. Euro AUD, I think it was 2015 or 2016. Hey, Sami, have you seen any institutional trend recently in the market with all the fundamentals happening? Like I said, just at the beginning of the section, there is no institutional trend right now, because to have an institutional trend, you need, a strong fundamental, so strong fundamental, and you need a predictable fundamental, right? So you need both of them. And right now we don't have a predictable fundamental, and institutional trend cannot exist right now. But later, when everything comes back to normal, you will see them appearing once again. Are institutional trades present when fundamentals are flat? Nope. Only when fundamentals are strong and predictable. So does institutional trades apply to every pair, every index and commodity? I've seen them on the 6 pairs and on gold. The other indexes, I did not look for them. They might happen, they might not happen. You can look at them, in your back testing when you practice. But I can tell you that they exist in these 6 pairs and on gold as well. So now let's do an example from the start. Okay, so let's say you have this naked chart, basically, and you start working on it. And this is how you discover an institutional trend. So basically, this is the same screenshot, right? Naked chart. This is just you working on the chart. Okay, so you trace all your key levels daily for hours. And then automatically you see that there's a trend going down. You have a downtrend here, and basically you can take your Fibonacci channel tool, Fib channel tool. You can divide it into 4 sections. You are at 4 hour. You are in a downtrend. Basically, you have your heart line that is respected, 45 degrees, sustainable. Everything is good. You have 1, 2 Elliott wave, 3 doesn't exist, 4 doesn't exist, 5 doesn't exist, but you can, expect them to happen. And basically you are right here. So it takes a bit of vision, a bit of creativity to go, from this to this. Okay, but once again, experience and time. Those are the keywords for trading in general. We have a question. Do they always last around 45, 60 days, or they can last for much longer than that? I would say even shorter than that. Sometimes it's going to be maybe 2-3 weeks. Okay. So maybe 20 days, up to, I would say no more than 3 months, no more than 90 days. I did not see more than 90 days. Might have happened and I missed it, but I did not see a trend like that more than 90 days. Is this GN? Yes, that is GN. And that's the final product. Once you start working on it, you place your trades, and you follow it throughout multiple days. So on the previous one, we were at wave number 2. Big bounce, make your trade, add the position here, break will go, big bounce here, close the position here. Here you have ABC correction of wave number 4. You can trade B to C, right? Big bounce here. At the end of wave number 4, you have the start of wave number 5, big bounce. And I did not add any position, but I could have added a position right over here. Why? Because we have a break, hook, go. Okay, so I could have added a position there, but in that case, I did not. And basically, we reach zone number 4, and you would exit the trade around here. Since the trade is completed, you have an inverse head shoulder at the end, and the institutional trend is over. So once again, 3 trades, 5 position, 2,259 pips in total, 26 days from here to here. Okay, so a bit more than 3 weeks, a bit less than a month, and you have 2,259 pips. I think, yes, that was GN. Okay. And that's it for the institutional trend. Is there any questions regarding that? How can we identify that it's an institutional trend before wave 3 forms? Just like this, right? You use the rules, you use your creativity, you use your vision, you use your experience, and you expect it. You make a prediction. Just like this example. Might be a bit abstract now, but the more you practice, you'll see it's not that hard. It's not the most difficult part of everything that we've seen so far. How do you find the end of wave 5? You don't know the end of wave 5. Yes, you can do your fib and it's going to match, okay? But let's say if the Fibonacci tool did not exist, basically wave 5 will finish in zone 4, somewhere. Okay, so somewhere in zone 4. How much time would you recommend to backtest this style? I would say not that much, because like I said, right now, there's no institutional trend in the market. And even in a normal market, they don't happen that often. So don't put all your time on this. Put your time on the rest of the stuff that we've seen. Rule number 2 and rule number 3 for Elliott waves are not present yet. Yes, but they are confirmed as long as the trade advances. Because at the end of the day, even if it's not an institutional trade, you will still do the same trade. It's still a big bounce. This is still a break could go, and this is still a big bounce. Okay, you just get the confirmation along the way. Why not trade correction wave 4? Yes, we traded right here. There's a wave, BC correction 4, right over there. From the start, because you don't know where it ends. Okay, you might think correction 4 ends there, and you see it went back up and went back down. So if you entered there, you would have been stopped out. That's why. That's why we trade the BC, because you already have the movement that has started and you have the confirmation. All right, so let's go to our next topic. But we have one last question. Once the whole move finishes, what's next? How much time do you wait for another ride? I don't know, man. You tell me. It depends on on the fundamental context. It depends on your break could go. It depends on the analysis. There's no rule for that. Okay, it's not something that you just follow like a robot. You have to use your creativity, your insight on every situation, and every case is different. But at the end of the day, you go back to square one. You go back to your trading plan, you do your fundamental, you do everything in order, and you will find the next trade. Okay, you're not going to trade from here to here, and then from here to here, and then from here to here, and then just do swings like that and have perfect accuracy. That's not going to happen. You're going to take small chunks of the market when they are predictable and you have a high probability setup, and that's it. All right, so Fibonacci, okay, the last section, the last big section, let's say, of our technical analysis. Then we have the small divergence section at the end, which is very, very small. So Fibonacci, okay, what's the purpose of it? Is that, well, now that we have our entry point to make our trade, we need to confirm it and choose where we will put our stop loss and take profit. We will always choose our stop loss and take profit with Fibonacci and confluence. So confluence is basically trend lines, basically support resistance, basically moving average, and psychological level. All that stuff is confluence. So confluence plus Fib. There's always two types of movement in the market. Impulsive leg will create a higher high, lower low. Okay, so it's pushing the price either up or down depending on the trend. Corrective leg will not create a higher high or a lower low. It will correct the price. In order to use our Fibonacci tool correctly, we need to find the last impulsive leg of the movement. Then we measure it, and it will give us all the proportion to set up our trade properly. Okay, very important. Fibonacci does not tell us if the market will go up or down. You should already know that before using it. Of course, it will just confirm our position and place our stop loss and take profit. So the only goal with Fibonacci is to find the last impulsive leg. Then you will trace it. It will give you all the numbers, and you will choose your stop loss and your take profit. okay? Literally doing your Fibonacci should take you, once you're, used to, is going to take you between 3 to 6 seconds. Okay, literally. Okay, I do 3 fibs in less than 10 seconds. Okay, it's very simple, it's very easy. You just need to really understand correctly, but to use it on your chart, it's very simple. So basically, actually, let's go to the next image here. Here, basically, let's say you have a certain, movement. Let's say this is a consolidation in the market. You need to be able to recognize the difference between an impulsive movement and a correction. Like I said, in impulsive movement will create a higher high or a lower low, and the correction will not create that higher high or lower low. So for example, let's take this impulsion here. Okay, it starts here, it finishes there. Okay, this is an impulsion. Why? Because we made a lower low. So lower low, we're pushing the price further. So basically, this is an impulsion. Okay, the next one goes from here to here. This is a correction. Why? Because we do not make a higher high, here. Okay, if the price extended be more than this high, it would have become an impulsion. Sometimes you have both, like this one here. Okay, this movement starts here, finishes there. This is both an impulsion and a correction. Why? Because I have this high here, right? It breaks it, it makes a higher high, but I also have this high here. Maybe this high was in, let's say, 1 hour. Maybe this one was 4 hour. Okay, so the movement here, this leg, okay, this leg of the movement is an impulsion in 1 hour, but a correction in 4 hour. So sometimes it can be both of them. So now let's get to our chart, see how we're going to apply it. So let's see here, I have a triangle, okay? How do we trade a triangle? Break or go, either to the upside, downside, okay, depends. How can you know in advance where the triangle is going to break? Fundamental, okay? If the fundamental is mixed or if the fundamental is flat, what do? We don't know. We don't know in which direction it's going to break, and you wait for the break hook go. So if you don't know if it's going to break up or if it's going to break down, you wait for it. And in any case, even if you know the direction because of the fundamental, you still wait for the break hook go to have your proper entry. So basically here, I just made an example of how you should visually see the impulsive and the correction legs of the market. So for example, let's say we start here. From here to here, this is impulsion, okay, because we make a lower low. From here to here, this is a correction. From here to here, this is an impulsion. From here to here, we'll see it's a correction because it did not make a higher high. From here to here, correction. Here to here, let's say impulsion. It's pretty close, but it's technically an impulsion. Then correction, then impulsion, correction, impulsion. Here, impulsion, correction, correction, impulsion, impulsion, correction, 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 and lastly, impulsion. Okay, so we said that to draw our Fibonacci properly, we need to find the last impulsive leg. The last impulsive leg would be this one. So the last one, actually. So here we have our breakout. So just right after here, the market decided to break to the downside. So here we have our break. Okay, so from here to here, that's an impulsion. I can expect a break, hook, go, and continue to the downside. And I will, use my Fibonacci on this leg here, so I can choose my stop loss and my take profit when that break, hook, go comes to life. So Once you have found the last impulsive leg, you trace your fib in the direction of the movement from wick to wick. So from the top of the wick to the bottom of the wick, I will trace my Fibonacci, okay, in the direction. So from top to bottom in this case, since we're going down. So here I have my break. So break here. Is this the hook? I don't know. I don't know if it's the hook. I don't know if it's gonna keep going down and I will have to readjust my fib and then hook a bit later and then continue. I don't know. We're going to see. So maybe a hook. And then basically we're waiting for the go afterwards. But this is how you would place your fib. Those are all the level of the Fibonacci, okay? Just something to mention, these levels and these levels are the same, okay? It's a mirror. They're not different levels, they're just, you know, up or down. Those are the fib retracement settings on TradingView. So when you adjust your tool, you can write down those settings in your TradingView. And now let's explain every number and how we are going to use them, okay? So we have the black numbers, we have the green numbers, we have the red numbers, okay? The black numbers are for break, hook, go, big bounce to enter a trade. Green numbers take profit, very simple, and red numbers stop loss to define when you put your stop loss. Let's start with the black numbers. We have 4 choices, we have 4 levels, and each level has a different personality and a different purpose. Let's start with 38.2. 38.2 only for break, hook, go. You should expect the hook at 38.2, okay? Why? Because when we have a breakout, the market is very, very, very excited, and it doesn't have time to have a large retracement, okay? So if I have my triangle like this, I have my breakout, okay? It's not gonna go all the way down, then up and all the way down, okay? The market is too excited. The market is going to do a move more like this. It's gonna do a small breakout, small pullback, and then it's going to continue. Market is very excited when we have a breakout. That's why the 38 is break or go only, not a big bounce. And let's skip the 50%. Let's go to 61.8. 61.8, big level of retracement. You will find your big bounce entry at this level. So for example, you know, you have a confluence of trend lines. You have a trend line like this. You have, you know, your channel, let's say like this. Let's say you have your key level like this. Here you have your big bounce, right? And I don't know, the market does this, that. Probably not a good example, but if you measure from here to here, here would be the 61.8%. Okay, we're gonna do some example later on, but that's where you will find your big bounce. It's a confluence element to add to your trend lines, your support resistance, and everything else. The 50% now is a hybrid level, can be used for break or go or big bounce, psychological level because it's the middle of the movement. So it can sometimes act as a 38 and sometimes it acts as a 61.8. It can be both. And finally, the 78.6, my personal favorite, used for mega big bounce institutional level. Okay, this one is going to be more rare, but when it happens, it's very solid. Okay, so basically, let's say I have a movement down, I have a retracement, I have 38 here, I have 61 here. Actually, let's say 38 here, 50 here, 61 here. Okay. When a retail trader starts to learn about Fibonacci, what is the most, I would say, common Fibonacci that everyone talks about, every article, course, YouTube videos says that is the golden number? It's the 61.8, right? The retail traders think that the 61.8 is the the best number, and every time that the price reaches 61.8, you should enter here, okay, without any sort of confirmation. And institutions, well, they know that information. So if the retail traders enter at 61.8, they will, of course, put their stop loss just a bit above, right? Very logical. So the market might bounce off a little bit like this, but just over here, you have our good friend, the 78.6%, okay, just waiting over there. And the institutions, they know that the stop losses are here, okay, that the retail trader noobs just entered for no reason at 61.8 because they read BB Pips 2 times and they watched 3 YouTube videos. So what did they do? Well, they push the price and they push and they push and they push beyond the 61.8, all the way to the 78. Every retail trader gets stopped out of the trade, okay? The retail traders, they always put small stop, stop losses. They over risk, and they put a stop loss of 10 pips, 15 pips, 20 pips, and they hope that the trade is going to go right away. So it's very easy to stop them out, okay? And as soon as we reach the 78.6, we wiped out all the retail traders that entered at that level, and then the institution do the mega big bounce. They will open their big position, and then the movement will happen, okay? And each time I see that, it's always beautiful, okay? Like I said, it's more rare, but when it happens, and let's say you have some confluence, you have a trend line coming here, you have a key level there, for example, you have a psychological level as well, you have a trend line coming like this, for example, you have this confluence with the 78, you see that 61.8 is in the middle of nowhere, let's say, but we see some retail trader coming in the trade. They're going to be stopped out. It's going to go to the 78, and at that moment you have your mega big bounce, and the market is going to react very, very heavily because a lot of liquidity is provided by the stop loss of the retail traders who are getting stopped out. Okay. Now, red numbers, which is the stop loss, you have two numbers, 88.6, 113%. Both will be used for the stop loss depending on the trade setup and your entry point. You will choose one or the other. So if you enter at 61.8 and you're worried that the price pushes beyond and go to 78.6, okay, there is no worry at all, because your stop loss is always going to be at least at 88.6 or at 113. You have a lot of space between your entry point here. Even it goes to 78 and goes back down, you are safe here and you are safe there. There's no worry about it. Look at your elements of structure, confluence, and make sure you have enough space for your stop loss, of course. As a general guideline, when you enter on a fib level between 38.2 and 61.8, you will choose 88. And when the fib levels between 68 or 76, you might choose 113. And now, lastly, the green numbers, extension levels for the take profit. You have multiple choices, 1, 2, 3, 4, 5, 6, 7, 8 choices of take profit, but they are all the same. They will all be used the same way, okay? Those are just choices. So basically you have 8 choices of take profit, and you will have to select one of the 8 choices. How do you select one of these 8 options? You will choose a level according to the elements of structure and the size of your fundamental idea. Do not hesitate to take partial profit on these levels, okay? So basically, if you have a small fundamental idea, okay, will you go for that extra long take profit? No, you might go for these 3 first. So that's maybe small, fundamental. Maybe you have medium fundamental, you will go for these guys. And if you have a large fundamental idea, you will go for these choices. And between these three or two, you will choose one that, is in confluence with the rest of your chart, with your trend lines, with your, key levels, with your psychological levels, with your moving average. You will choose, the one that has the most confluence. So let's get back to our example and just see a practical application here. So once again, we have the same fib from here to here. You see that when we broke our triangle, we had a bit of consolidation. So all of this is the break and the hook. We had the hook at 38.2. We said that 38.2 was for the break hook go. The 50% can also be break hook go or big bounce. So that was another option, but we got our confirmation with the 38. So that's good. And now, basically, I have my go. This is my go. I'm at a lower low. I can enter the trade right over here. Okay. Now, what's remaining? I need to place my stop loss and I need to place my take profit. And that's it. And my trade is good to go. So how are we going to do that? Let's look at a take profit. So here are all the levels of take profit. So my triangle here is here. My break hook go is right over there. And this is the space in front of me. So I will look in the past to find some confluence and see which levels are the most important. So I see this level is important, this one is important, and this one is pretty solid. And this one too at the end here. Okay. Now I have 1, 2, 3, 4 choices. Okay. So I went from 8 options to 4 options just by looking at the confluence. But then how do I make a choice between these 4 options? I will have to consult my fundamental idea. If it's something that is small, I might take the first one. If it's something that is medium, I might take the 2 or 3. And if it's something that's large, I might go for that 4th take profit, that extended take profit. Okay. So it depends on your fundamental idea. So basically that's it. That's how your chart looks like. Technically you would have, your key levels daily, 4 hours, all your trend lines. Your chart will be technically a bit more messy, but it's the same thing. Just I didn't put it to make the example more simple. So we are here, and that's how I decide to place my stop loss and take profit. So stop loss goes to 88.6. There's way enough space for my, trade to breathe, even if, it plays around here and decides to go afterwards. There's no worry. And a take profit, let's say I had a big fundamental idea, big fundamental trade. I decided to take the last one at 261.8. Okay. I have a good risk reward ratio. And this is for partial profit, partial profit, partial profit. Those are obstacles along the way. Because sometimes you might select a take profit and maybe it's too far. Maybe you just, were a bit too optimistic about the trade, and the trade goes here and bounce back and goes back up, right? So that's why you need to identify your obstacles, find your levels of partial profits, and make your stop loss break even as soon as you take your first partial profit. So, all right, our trade is ready to go. So let's make the trade. Let's see what happens. So basically, that's what happens at first. First obstacle, partial take profit if you want, partial take profit, stop loss, break even automatically, and you keep going. Second obstacle, partial take profit again, and finally you have reached your take profit. So simple trade, efficient trade, 221 pip, 15 hours, very quick. which means that the institutions entered exactly at the same place as you did. You made a beautiful trade. Your capacity to follow the institutional movements have been successful, okay? And basically you see you selected that take profit at 261.8, and it was the same, okay, same take profit as the institutions. Okay, you had the same take profit as Goldman Sachs and JP Morgan and HSBC. As soon as it touched it with ultra precision, the market, reversed. We had a bit of consolidation, a bit of distribution, and the market reversed directly. So this whole thing means that you made a beautiful trade, you made a beautiful analysis in terms of the technical, in terms of your fibs, in terms of your fundamental, in terms of everything. And this is a 10 out of 10 trade. And that's beautiful. Okay, so if I see something like that from you guys, I'll be very happy, and I will say that it's a beautiful trade. It's a clean, efficient trade. Okay. So now let's do an example from the beginning. Okay, we have a naked chart right over here. You would do your daily key levels, 4-hour key levels, just like we've seen. Then you would do your daily trend lines. You would do your 4-hour trend lines. And you would also do your 1-hour trend line. Then what do we see here? Do you see what I see? What's this level here? That looks like a confluence, right? So here you have a big bounce. As soon as the market reaches here, big bounce, and we go back up. Of course, you did all the fundamental work before. And now it's time to place your Fibonacci. So here you have your confluence level with everything, and you will trace your fib on the last impulsive leg. So your fib starts here, you see, and it ends right over here. And this wick is ignored because it was either a stop hunt, you see that you have this big stop hunt, or it could be a fundamental event. The last impulsive leg is this one, because you have impulsive, you have correction, and then the next one is going to be the next impulsive. Very simple. Okay, you don't start from here because here you have this movement here. Okay, you cannot skip a high and go straight from here to there. You have to start from the last low to the last high. So this is my fib from low to high, wick to wick as always. And look at that, 61.8, perfectly matched with my confluence level. Wow, how beautiful. So I have my trend line, I have my trend line, I have my trend line, I have my fib, I have my key level here. And basically the price is right over here, but it's coming down, right? It's coming down. What do? Buy limit. You don't even need to think about it. You can close your eyes, put your buy limit, go to sleep, and everything will be fine. Okay, this is a very high probability setup. If your fundamental is good also, this is a very, very, very clean trade. So basically the market goes here, okay, to the R61 like expected. Our buy limit gets triggered, or if you entered manually, it doesn't matter, okay? And now we just need to place our stop loss and take profit. Technically, you would do that before the trade gets triggered, but for the example, let's say we do it afterwards. So let's start with the stop loss. So you see from here to here, something has changed. A new Fibonacci has appeared, okay? Before we just, had this Fibonacci, but now we added this one too. What's the reason and how does it work? The reason is my entry point is here. I said stop loss would be 88 or 113. If I put my stop loss, here, it would be way, way, way too big. Okay, I would know that my trade is not good way before it reaches the 88.6. The stop loss is way too far. So I have to do a new Fibonacci to find the new stop loss. Okay, and basically I did it on the movement previous of this one. So we had this push down. The previous movement, which was an impulsive leg, I made the Fibonacci from here to here, and it gave me that 113%, which gives me a perfect stop loss and gives me enough space for my trade to breathe. Okay, so to position my stop loss, if the stop loss is too big, I will add another fib. Okay, so I can sometimes add a second fib for the stop loss. Okay, and sometimes I might add a third fib for the take profit if I need to. If you don't need to, you don't need to put a third fib and you don't need to put a second fib. It's only when you need to. So in this case here, I put my stop loss here. And my take profit, well, it's already laid out. I don't need to create a new fib for the for the for the take profit. So basically, that's how I would do it. So we don't see it's hidden behind, but we have a confluence of the minus 27.2% of the big fib. So if you look on the right, you have this big fib, right? And the small fib, this one, here, right over here. Okay, you don't see it because it's hidden by this tool. You have the minus 61.8% right there. And you have a confluence in that level with the trend line as well. Okay, so basically that's why I chose that take profit, and also will depends on the size of the fundamental idea. Okay, however, to go from here to here is a long way, right? It's 815 pips. So you need to identify the obstacles along the way and be prepared to take some partial profits. So we have this obstacle, this obstacle, this obstacle, and this obstacle. Technically, this is an obstacle as well, just it's alone. This is an obstacle as well, and the high here is an obstacle. So you have like 4 main obstacles and you have like 3 little ones. So now let's see what happened. So market pushes. We reached our first obstacle, which is this big key level trend line that comes from I don't know where, and comes all the way here. Big obstacle. Here, what do? Trade management, partial profit, stop loss, break even. That's it. Then you continue. You get to the second obstacle right here. You have this trend line, beautiful trend line, and you have another trend line, key level trend line with the 61.8 fib obstacle. So once again, partial profit. And then here you can take some partial profits, and then finally we reach the final take profit. Okay, so final take profit, 815 pips, 9 days that it took to complete this whole movement here. Okay, even if you close the trade here or here or here, honestly, it doesn't really matter. Instead of doing 800, you would do 400 or 500, 382.3. It doesn't matter. Sometimes you're gonna get more pip, sometimes you're gonna get less pip. The important is that you get the concept, that you understand how to put your fib correctly, and you find your obstacles, take your partial profit, put your stop loss to break even, and then the rest is pure profit. You have no risk on the trade. Here I could have added the position, break or go, but the rest, no position could have been added. Okay, I could have, traced a trend line, just, something like that. I don't have the tool to do it properly, but something like that. Break will go, pull back on the resistance. Resistance became support. Very simple. Add a position, and we could have had another position. And that's it for Fibonacci. All right. So do we have any questions regarding that? Now is the time. Do you trail the stop loss at each obstacle? Nope. You put it at break even and you leave it there. What is the minimum number of structural confluence? Like I said before, I already answered, at least 2 to 3 minimum, depending on the quality of the confluence. The second fib is on the correction, since there was no high or low. On that example right here, when we did the second fib, we made a higher high. Okay, the last high is here. We made a higher high here. Okay, it's just a different scale because the movement is smaller. Does the size of the consolidation prior to the break hook go determine the size of the extension? Not always, but it's a good clue to have. So yes, sometimes it affects, but you should not, base your extension based on the consolidation. Why don't we add position at each obstacle? There is break hook go. Well, you can add a position on each obstacle, but you probably will end up losing that trade since you've been a bit too greedy and did not, make quality trades. Each position that you add in a trade is a trade by itself. If you add 5 positions on the trade, it's because there's been 5 good individual trades that you could have taken. How is the mirror fib used? The same way. There's only one way to use the Fibonacci, like we just saw. Nothing. There's nothing different. Like maybe you don't understand, but if you use the fib like this or like this, it's the same thing. It's just you putting from top to bottom or bottom to top. It's exactly the same thing. Can we see a trade from A to Z? You have it right here. And I just did a trade before on GJ. So you can, if you want to look at it again, this is a trade from A to Z with the fib. Like I said, 61.8. Whatever here. I could have done a smaller, fib for the take profit. Stop loss was here at 88. Pretty simple, pretty standard. So that was a trade I did this week. So there you have your trade. Very simple. And the market is a bit slow right now, so there's not much great opportunities to make big swings right now. Except on gold last week was pretty good. So is there any more questions regarding the fibs? All right, so let's get to our last section here, which is the divergence. And basically divergence is going to be always the last part of our trading. It's very easy, and it takes also, just a few seconds to look at. So you just need to understand the concept, and then to apply it, it's very easy. So we're not going to spend very much time on it, okay? So the final step of our trading plan is to double check our trade and confirm it before we execute. We have to verify the RSI and the MACD to understand if there's an hidden agenda from the buyer sellers institutions, okay? So what is the RSI? If you never heard about the RSI, it is a volume indicator displaying the strength of the buyers and the sellers. When the RSI is high, we have more buyers, and when it's low, we have more sellers. We will use it in 4-hour, okay? RSI and MACD, same thing, it's going to be in 4-hour. And we're going to use it for the convergence and divergence. Default setting, nothing to change. So it looks like this. Here it's low, here it's high. Like I said, more buyers here, more sellers there, okay? That's good to know, but we're not really gonna use it that way. Now the MACD, same thing as the RSI, volume indicator, displaying the strength of the buyers and sellers. The difference with the MACD, okay, is that we have the zero line and the signal line, okay? So what is the zero line? Well, you see here is the zero line. So this line right over here, that's the zero line. When it's above, buyers are in control. When it's underneath, sellers are in control. Very simple once again. And you see this red line, that's the signal line. And the signal lines gives us information about the momentum. You see here, it's outside of the histogram. So the histogram is like the blue lines. So here it's outside. And you see, for example, here it's inside. When it's inside, that means that the momentum is high. We have some good momentum. The price is pushing. That means that the institutions are pushing the price. There's a lot of momentum. When it's outside, it means that the momentum is low, and probably we have a consolidation. Consolidation, which means distribution, accumulation, something is going on. So it's good to have it, visually displayed there. But once again, it's good to know, but we're not going to use the RSI and the MACD in that fashion. We are going to use it for the convergence and the divergence, and that's it. Very, very simple. When we are about to make our trade, we have to verify if there's a convergence or a divergence. A convergence indicates us that there is no hidden agenda, and we have a green light to make our trade, okay? Divergence, on the opposite, tells us that there might be a hidden agenda. Something is going on behind the scenes, and we either have a yellow or a red light, depending on the confirmation from the RSI and the MACD. So the convergence is when the RSI and the MACD and the charts are doing the same thing. They are doing the same highs and the same lows. And divergence is the opposite, okay? When the RSI and the MACD is, against the chart, it does not follow the chart. That means that we have a problem. Let's make an example to make it more concrete. This is an example of a convergence right over here. Making lower highs, once again in 4 hours, okay? Making lower highs, going down. RSI is going down, MACD is going down. We have a convergence. We have a green light ready to go. We can make our trade, okay? Once again, this is at the end of our technical analysis. This is the last step before, putting our trade in. And this is the example of a divergence. Here we're going up, we're making higher highs, but the RSI and the MACD is making lower lows. There's a big problem. Here we have a divergence between the indicators and the price. This means that the price, okay, is being manipulated. Okay, it's being, manipulated by market makers. There's something going on. Okay, maybe some profit taking, maybe a stop hunt incoming, maybe just a bait for retail traders. So they think it's still, let's say, an uptrend and they want to buy that currency and then they're going to reverse. But at the end of the day, the price is being manipulated. So it's your job to try to understand what's going on. Okay, and say, well, is it a red light and there's something that I did not see? Or is it just a yellow light and I should be careful and see what's going on, what's happening with the market right now? Most of the time, when you see a divergence like this, I would say 90% of the time, it's going to be the institutions who are taking their profit. They are distributing, but they're distributing, and you see that in the volume. You see there's more sellers in the market, but the price keeps going higher and higher because they're hiding their transactions in the market with advanced software and make you think that the price is still going up, but in reality they are distributing and taking their profit. All right. So here, another example of a convergence. Here, convergence. Let's say you had a big bounce there, trend line, I don't know, a key level, trend line coming here, this like that, whatever, you do your fib, everything, big bounce. You would look if you have a convergence. In this case, you do. So green light, you make your trade beautiful. In the case here, you have, the price making higher highs, but here you have, the RSI going down and the MACD, being flat. Okay, so we have a divergence, okay, because it doesn't follow exactly. So if you wanted to buy somewhere here for whatever reason, okay, here I don't find a reason to buy, so you would skip. You would not even need to look for the divergence. But sometimes when you're about to make a trade, you will see the divergence, and this tells you, no, something is going on. Be careful, okay? And you see at the end of the divergence, the uptrend stopped really sharply, and we had a reversal right here. So most of the time when you see a divergence, it gives you a hint of a reversal. And why is that? Because the institutions are taking their profit and are distributing for a certain reason. And you have to find that reason. Is it fundamental? Is it technical? Is it market sentiment? Is there NFP coming this week and they want to close the trade? What's going on? Okay, so you need to find that reason. Okay, so divergence is the indicator here, but it gives you the hint of the reversal about the institutions who are maybe taking their profit, which means that they are distributing. Why are they distributing? There's a reason, and that's your job to find out why. Okay, that's why I say either a yellow light or red light, and you scrap the trade. Moving average, we already saw them before, and that is it. We've seen everything. Now we've seen all the tools that you need to trade. Okay, I know that it's been a lot of information. Even me, when I give the course, I'm like, man, I wish good luck to these guys because there's a lot of stuff to cover. Okay, but let's do a quick recap. Okay. So before going to the questions, okay, let's just do a quick recap and then we'll finish off with the questions, okay? So first of all, okay, you always need to follow your trading plan, okay? And basically be patient as it takes, like I said in the beginning, between 1 to 10 days to create that trade. You always start with your fundamental. Okay, your fundamental, you look at the economic calendar. Okay, part 1, part 2. You save that information. You put it in the fundamental bag, right? For later on. You can trade part two if you want, if the numbers are good. After the economic calendar, you have the headline news in your fundamental. Headline news, okay? Once again, that gives you information. At first, when you are going to read the headline news, you have no context, so it takes time to get up to speed and understand what everything, what's going on in the world, what are the problems, what's going on with every currency. Okay, so the headline gives you that information, and those two information, you put them in your fundamental bag. When you have that fundamental bag that is loaded with information you collected from here and from here, mostly from here, so maybe let's say 20-30% from here, but 70-80% from here, you will create your fundamental idea. Okay, fundamental idea, which will give you the direction of the market. Okay, once you have your fundamental idea and you know where the market is heading, okay, you understand the concept of market sentiment that we saw. You understand the concept of price action that we saw. Then you go to your technical analysis, okay? You understand the concept of accumulation, distribution, support, resistance, how the institutions work, and you understand that this whole process, okay, is just to follow the institutions. That's your only goal. And that's it, okay? So then you get to your technical, right? You do your key levels, daily 4 hours, okay? Once that's done, you identify the trends in the daily 4 hour, 1 hour with explanation, okay? So you identify and you explain. Then what do you do when that is done? Okay, you take, well, actually I should probably put it like that. You take your idea and your your different trends, and you make the bridge. You make the connection between the chart and your idea. Is your idea good? Can you confirm it with the trends that you see on the daily, the 4 hour, and the 1 hour? Okay, so basically explain the trend on every time frame. Okay, now that you explain, okay, and you have the bridge, you also solve the puzzle. Which is daily plus 4 hour plus 1 hour equals the answer. Okay, that's your answer right there to what's going to happen. After that, you get your bias, long or short, with all the reasons why. So those are all reasons that are based on facts. Okay, so you do this part, you do this part, you connect together. When everything is connected, what do? Then execution. You need to execute it. Execution. All right, how do you execute it? Trend lines, fibs, moving averages, different types of levels of structure. And all of that, you need to find either break, hook, go, big big bounce and 3 points, right? Which is part of your execution right there, okay? Which is what we've been doing this whole day. Once you have your break or go big bounce, you use your fib, okay? Let's continue, let's say here, use your fib for stop loss, take profit, okay? Make sure you have your good risk reward, make sure you have, so verification of the risk reward of your obstacles along the way, and finally of your convergence versus divergence, okay, which is your final basically verification, making sure that everything is good. And when that is done, follow the rules plus risk management, and plus no emotions, okay? You manage your emotions. And that gives you the big answer, which is this goal to follow the institution, which means pips, which means profit, which means growth, and that equals pro FX trader. And that's it, okay? You have everything on the same page, okay? So basically, this is all what we've done this weekend, okay? As you can see, there's a lot of information. If you want to take a picture, a screenshot right now before I remove it, take it, and at least you will have this whole form of I don't even know how to call it, this whole linkage, trading linkage together. Okay, so take a picture if you want. And basically, that's it. That's how you become a good trader. Okay, and all of this will take you, I don't know, 2 to 5 years. Okay, of serious trading, putting in the work, being serious, no distraction, basically all that good stuff. Okay, and I think that's it. I think I pretty much said everything I wanted to say. So yep, so I'll answer some questions, so you can ask any question you want right now, and we'll make sure that everyone understands everything correctly. Can you give us an example of good journaling setup? Good question. I did forget about that. So journal, okay, very important, is a way to track your trades, okay, is a way to basically, see how you're progressing, look at your mistakes, do the review of your trades, okay? And basically, there should be 3 things in your journal. Basically, the trade stats, what currency, entry point, basically stop loss, take profit, everything you see on your MT4 or C trader, your trade stats, you write them on. What time did you open the trade? How much risk did you take on that trade, and so on and so forth. Okay. Now, after that, you will write your technical, so tech plus fundamental idea for the trade. Okay. Why did you make that trade? What's the fundamental reason? What's your bridge? What's your technical reason? What was it, a brick of go? Was it a big bounce? How did you define your entry? Everything, write it down. And at the end, you do a review. Okay, review of your your trade. Okay, did you make a mistake? Did you make a good trade? What did you do differently this time? And that's it pretty much. Keep it simple and keep it efficient, so you don't get lazy to write your journal. If it's simple and easy, you will want to write it down. Okay, if it takes you 5 minutes to write on your journal, it's going to be fun. If it takes you 30 minutes, 1 hour to write everything down, it's too much work. You're not going to be able to be consistent with it. So keep it short and sweet and efficient. Okay, so that's it for the journal. Do you always check divergence, convergence before entering a trade? Yes, that's what we just explained. We know fundamental data schedule. In which week have you had the most success? 1 to 4 has nothing to do with week number 1, 2, 3, 4. It's irrelevant. 2 to 5 years is reasonable, knowing the amount of information we need to retain. Is 25 to 30 hours dedicated to trading going to fall align with that time frame for us who are fully timed employment? It's not the amount of hours that you're putting in. It's honestly just the number of quality hours. You could spend 2 hours every day, but on a consistent basis and being very, very focused, and you would achieve that goal in 2 to 5 years. So you don't need to go full time. You can still work, go to school, live your life. I would recommend at least 2 hours per day. That should be well enough. What is your typical weekday look like? What time you wake up? Look at the chart, news. I would wake up between like 8 and 9 a.m., just regular. I would look, Forex Live, look at the news, economic calendar first, then open the charts, see, if there's some charts to be, drawn. If there's some old charts, I will redo them. If not, once you do your chart, you don't need to do them every day. So you just look at them. And I would say I would spend maybe 30, 45 minutes in the morning looking at everything. And then afterwards, I would just do some other stuff. And basically, I would come to the chart at least 2 other times during the day. So maybe in the afternoon and in the evening. And that's pretty much it. So I don't spend more than 1 hour and a half looking at my trading. Do you use your phone or computer to trade? Computer, of course. Is there a particular app you find is ideal for journal? Yes, this one. Okay, it's called a book. Okay, I like books, so I just write everything down. But you can use any app; it doesn't really matter. Will we be added to the Telegram channel with other students? Yes, I will send an email to everyone later today with the details of what you need to give me. And yes, I'll be able to add everyone in. Do you trade price imbalance defined by the financial institutions? I don't know what that is. So no, I don't trade it. How do you manage to hop on track after vacation, pause from trading? Do you read everything, what happened during your absence? Yes, that's what I do. Like I said, when we discussed yesterday, the session wraps on Forex Live, I said, if you're missing, the fundamental for a few days, you just, hop on the session wrap section and you read everything that you've missed. And I'm used to it, so I can go on vacation and come back and get into it pretty fast. But if not, just take your time. You can even trade a demo account for 1 week. There's no rush. So take your time and make sure you're in a good place in your head before you get back to your trading. Do you think spending more time can exhaust your mind? Absolutely. In the beginning, since you guys are learning, you can spend as much time as you want. But when you will start to trade seriously, it's very important to limit the time you spend in front of your charts. Keep it simple and efficient. I live in Canada just like you, and I can't stay awake in the Tokyo and London. There's no much problem with that, right? Indeed, I don't stay awake during Tokyo and London either. Like I said, it doesn't really matter which session you're trading as long as you have a good entry point. Yesterday you said you started by doing 8, 10, 12 hours researching and whatnot. How long did it go on for, and when did you start spending less time researching and looking at charts? I did that maybe for like 1 year, a bit more than 1 year, something like that. And then I started just doing less research when I would say you see what you see on the screen when this whole process was pretty much finished. That's where I started to put less time in researching. As we are newly adopting this trading system, would you recommend we go back in time to build our fundamental idea on a pair, or to start building it from today? Build it from today onwards. Okay, you can back test your technical, but for the fundamental and the rest, today and onward. What broker do I recommend? That's for you to research and discover. I already talked about it yesterday, how to choose a right broker, but I'm not going to recommend any broker. What is the Telegram group for students? I mean, what is inside the group? It's only for students if you guys want to talk mostly about fundamental ideas. Usually the technical is pretty much just the same for everyone. So sometimes, when the fundamental is more important, it's good to have some discussions, bring some points and basically discuss about it. So right now the fundamental is pretty calm. So, there's not too much discussion as the fundamental is flat, but the group is more for fundamental discussion, ask questions and that sort of things. Any tips for trading gold US 30? No special tips. You have all the tips in front of your eyes right now. There's no extra tips for trading them. How old was I when I started? I was 17 years old. Okay, so it was in 2015. So it's been 5 years, and that's it. How did you learn about how the institution trade? Good questions. And it's quite funny. I learned it by just spending so much time in front of the screen and just, trial and error, asking myself so many questions, looking at my ceiling for hours, having dreams about it, like it might be hard to believe, but no one showed me anything about this. I created all of that from my experience, trial and error, my observations, some tests. I'm like a mad scientist, and I did a bunch of tests in the market, and that's what I came up with, and it works pretty good, I would say. How much growth should we target per month? You should never have a growth expectation. You do the best trades that you can, and you take the number that comes at the end of the month. That's it. I never in my life said to myself, I want to do 20%, I want to do 10%, I want to do 5%. You just do it, and at the end of the year, you see your average, and you try to beat your average every year if you can. But don't put a certain number or expectation, on your growth, on your profit. Okay, that's a bad way to trade. All right, guys. So I think that's it. I hope you enjoyed the course. I hope it was helpful. I hope it opened your eyes in terms of trading. Now you know how to properly trade. Okay. So I wish you all a very successful trading career. Maybe we're gonna, come across each other one day. And I will add all of you guys in the group. I will send the emails later today. And that's it. So I hope you enjoyed the course. Like I said, enjoy the rest of the day. And cheers. Cheers to many pips. All right. Take care, everyone. Bye.